Welcome to Remarkable Retail Podcast, episode number 307, the only podcast from two of NRF's top retail voices in 2025 and 2026. I'm Michael LeBlanc.
And I'm Steve Dennis.
On this episode, our guest is Jason LaRose, CEO Bombas, recorded live in our pop-up recording studio at the Commerce Next Growth Show in New York City. Launched in 2013, the meteoric rise of a remarkable, simple, and focused retail concept, Bombas makes the world's best versions of your everyday go-to socks, underwear, tees, shoes, and slippers. And with every purchase powering a donation to someone who needs it, you'll hear to date an incredible 200 million donations. In the news, lots to cover in the news in our summer bi-weekly format. Results from Nike, Aritzia, Costco, thoughts on Kroger and their ways of trying to acquire to compete strategy, and then what is on our respective radar screens. Speaking of our summer schedule, don't sleep on our periodic latest store tour videos, the ones in the can today that you can see on our YouTube channel, Nespresso and Nordstrom's World Cup activation. With more to follow all summer, recorded while we're in the Big Apple for Commerce Next. Steve, it's the dog days or halcyon days of summer for us both, depending on where you are and what you're up to. You, though, are getting up to some fun stuff with some great people we know. So tell us about it.
Well, at this point, it's just a save the date suggestion. I'm going to be doing a webinar with our friends at Placer.ai. That is going to be September 29th at 1 p.m. Eastern Time. So be looking for the specific topic and registration information a little bit further down the road. But yeah, save that date. I think it's going to be a pretty interesting session.
All right, September 29th. Now let's get into the news and results, plenty of them in our bi-weekly format. Now, interestingly, our guests, who you'll hear from a little bit later in the show, Jason LaRose is president of Under Armour, one in a long line of challengers to the Nike empire. What did you think of the Nike results?
Well, they were pretty unimpressive, I guess is probably the easiest way to say it. Nike's still not doing it, but they are early in their latest transformation. The revenues were down, depending on currency basis, 1% to 4%. They're projecting full year being pretty flat. Some people were a little bit confused because some of the headlines showed that they had quite a significant increase in operating profit. However, that was nearly $1 billion with a B, one-time tariff refund. So that really gives you a flavor for how much the tariffs have hit some companies, footwear obviously having a lot of imports. So that was worth 900 basis points, so 9% of gross margin. Just a little bit more detail on breaking out what's going on. Nike Direct was down 7%, but wholesale is now up. So folks that have been following this story would know that Nike really went very far on the direct business, pulled distribution out from wholesale. That allowed a number of players to kind of get in and take some of those positions. So they're really trying to recalibrate there. They also continue to struggle in China. China business was down 12%. So, they're both trying to dial up their product innovation. That's going to take some time. They're kind of refocusing some of their category strategies. So Jordan and sportswear are still pretty weak, and they've been discounting there. They are apparently getting some benefit, which is not too surprising, from World Cup effects of that business. So it's definitely a very mixed, but mostly meh kind of picture. So I think it is going to take them some time. One of the things I just observed, which I think we've seen with any number of retailers that have struggled over the years, is once you start to lose relevance and lose your customer base, it's hard to get it back. And that's usually because customers have found, the market share has gone somewhere. So customers have found other brands they like better. And then the question is, well, what can you do? They're satisfied with On Running, or they're satisfied with Hoka, or they're satisfied with Under Armour. What can you do beyond discounting to get that business back? So early days here, to be fair, but clearly things are at best stuck in neutral.
You know what was interesting to me when I looked at that wholesale number being up, that to me read sell-in for World Cup teams, right? Because they provide the kit for, I think, France and England, and you wouldn't see that in DTC till later, right? So I thought that 4% up in wholesale would be that load in.
Yeah, and I think the other thing, which is very much a long-term strategy, and I don't know if they're committed to it, but I think I mentioned this before. I worked with Nike very briefly when they were just getting started, with their consumer direct offense, their DTC strategy. And, back then, when they were talking about direct to consumer, it was both online and it was their own stores. And they very clearly overshot the runway in going to e-commerce. But the store strategy never really seemed to get going. I don't understand why that is. I don't know if they thought, well, rather than have to find all these locations and invest all this capital, let's just try to do it through e-commerce, kind of misreading that acceleration that happened post-COVID. And we'll talk about this with our next story. When you look at some of these brands that have been able to balance a good wholesale strategy with a good consumer direct strategy, which is both online and a very significant store presence. I don't know that Nike's really going to get that growth over the long term unless they can figure out their own store strategy in addition to getting the wholesale pieces and the e-commerce pieces right. So anyway, that's not something that's going to happen overnight. And it's not clear to me that they're committed to doing that.
Well, it's great points. Now, you did some work with Nike. I did some work with Levi's back in their very early days of their direct strategy. And, they've had their ups and downs certainly since I've been there, but looks like they're on a positive trajectory. Talk about it.
Yeah, it's been a journey for Levi's. I think, if you go back quite a while, some of their challenges there were product innovation. Premium jeans became a big thing. People were trading up. They were losing some relevance. They were very concentrated in wholesale channels and some of their key partners, Macy's, Kohl's, and others struggling. So, but if you look at what's happened over the last couple of years under the leadership, it was started before her, but under the leadership of Michelle Gass, it's pretty impressive. They had strong comp growth, overall sales up 8%. So that's generally better or definitely better than the overall industry average. And the profitability is happening as well. Net income up over 30%. They took their guidance up, gross margin hitting nearly 63%, which is a really nice gross margin when you've got a big wholesale business. Their inventory was down, so they seem like they're really managing that part pretty well. And I thought interestingly, because we've been talking about the impact of inflation in a lot of these numbers, what Michelle Gass said was that about 2/3 of their sales growth came from unit increase, not price. So that's also a good indication of some momentum. So, in a way, this is a real, as I kind of alluded to at the top, this is, pretty stark contrast to Nike, both in that they're brands that have been around for a while and are huge and global, but also really getting this mix between their own stores, their online business, and the wholesale business continuing to perform pretty well. And last thing I guess I'll add to this is this growth is not happening just in jeans, just in milking the 501, 503 franchise. They're getting it in the women's business. They're getting it in the tops business. So they seem to really, for a very mature brand, really be able to move the dial forward. And you don't really see that too often. So it's pretty impressive.
Well, from Portland to San Francisco, now heading north to Vancouver, Aritzia, they continue to just post numbers. Like
right. We're working our way up the Pacific Northwest here. Well, Aritzia, we've talked about Aritzia before, and much smaller brand for sure than Nike and Levi's, but a multi-billion-dollar business now. I don't know that I've seen a comp store sales number. Like when I read this, I thought it was a typo. Their comp store sales were up 35%. Total revenue up 43% because they continue to open quite a few stores, particularly in the U.S., where they hope to get to a couple hundred stores over the next few years. Another case where growth was driven by traffic and units, not largely price increases. So again, that's pretty impressive. The digital business is on fire, up almost 60%. Now, one of the things they called out in particular was they launched a mobile app last fall, and the sales through the app are already about 30% of online sales. And so, and Canada, which of course is where they started and is their most mature market, that business still grew 25%. So, it seems like a lot of different pieces, product innovation, marketing strategy. Some of their newer stores are bigger. So to the extent that's, driving comp, we've talked about GLP-1 driving apparel more broadly. So I think a lot of things are working in their favor, but I think you really have to look at this as being great strategy, great execution, we'll really see as they go forward, as they expand into the U.S. and perhaps some other markets, whether they can keep this going. But really, really impressive on top of numbers that have been good for multiple quarters.
Well, I was particularly impressed by the Canadian numbers just because they've been here so long and they've already, they're not opening stores at any kind of pace, though they did announce that they're opening a new store in the former Nordstrom location. So, just to post 25% also tells me at that perspective that their product is winning too, right? Like their product is really winning because it just showcases it in their home, in the home turf. Now, one of the things one of the stores you and I popped into when we were in Soho was Goo, which is the fast fashion brand, new in the U.S., but popular over Japan, Taiwan, and Hong Kong, of this particular retailer who also has some great numbers.
Yeah, well, Uniqlo, which are very much a global brand. Actually, the parent company is Fast Retailing, in case people aren't aware of that. But they had revenue growth up 22%, mix of comp, and they continue to open quite a few stores. Operating profit up nearly 40%. They also raised their guidance, and pretty much growth came from everywhere. North America was strong. Europe was strong. The China business, which has been tough pretty much for all the global brands, coming back. So you see Nike's issues, but apparently Uniqlo is immune to some of those issues. And of course, everybody who's a global player in retail really is experiencing inflationary pressures, supply chain logistics challenges from the Iran conflict. One of the things they called out, which I hadn't really thought about very much and is not an issue for Aritzia, but is presumably a bit of an issue for Nike and Levi's, is that a lot of the European stores were closed or have been closed for some number of days because the heat has been so bad. So despite being offline and not a huge percentage of their stores and not a huge number of days in the quarter, still that was definitely a headwind. So the one thing I was wondering, when did Uniqlo actually start, and how many stores do they have now? Well, I looked that up, and their first store was in Hiroshima, actually, opened in 1984. So they're just over 40 years now, but they are now at 2,500 stores worldwide. So really an impressive global business that's driving way above average growth.
And they haven't been pushing the gas pedal on new stores. They've had a nice steady growth, though they just announced 5 new locations in Canada, and they're already here. So there's no question.
Yeah.
There's lots of room to grow.
Yeah, they're making a pretty big push in the U.S. as well. I mean, it's not crazy numbers, but their stores are pretty good size, and so it's not inconsequential when they add a few stores to their total numbers, particularly in markets that they aren't fully penetrated, which for sure they're not in the U.S. yet. But I think to your point, they it's really a pretty essential business. Like, it's not a particularly fashion forward business. So while they do have product innovation and they do have these great flagship stores, this is not about just, they're not really, I think they're sometimes thought of as a fast fashion brand, but they're not super trend forward. No.
And their technical wear too is very strong.
Yeah.
I hadn't thought of this as all this news came together, but we're back on the West Coast now, and this time in Seattle with Costco.
Yeah, this was not a strategy to pick only Pacific Northwest brands, but this is just a quick hit because these are not quarterly earnings, but some folks may know or remember that Costco is very rare in publishing their monthly sales numbers. And there is just more evidence of what we've been talking about multiple episodes so far this year, of this great retail concentration where these big players are growing much faster than the industry. So Costco's, I don't know how many months it is now that they have posted far better than average sales growth. Their sales were up 10.6%. That's 7.6% comp for the past 5 weeks. If you look at how they've done so far for the calendar year, or their fiscal year, which is 44 weeks now, up almost 8%. Now, they are getting a little bit of a boost because they have such a big gasoline, fuel business. Yeah. And that is both the inflation in gasoline prices, but also because they use that as a traffic driver. They do disproportionately well when gas prices are high. But also, and this is very much not the fuel business, their digitally enabled comp store sales are up 21%. So it just seemed to be firing on all cylinders. So I fully expect when we see their quarter, which is still like 2 months away, it'll be another great quarter from them.
I love their reporting of the numbers, particularly as they break out sales growth X or net of gas, because gas is so important, as you turned out. I think they're going to have to start breaking out sales growth net of chickens, of roasted chickens.
Roasted chicken and hot dogs.
Good wrap up. We'll be back with more news about Kroger and a few other things. But for now, let's get to our great interview with Jason LaRose from Bombas.
Well, Jason, welcome to the Remarkable Retail Podcast here at Commerce Next. You are literally fresh off the stage.
I am.
Yeah. And
thanks for having me.
Well, we're happy to have you here. And actually, we work out these discussion guides ahead of time. And then, I often experience when I hear folks on stage and I'm like, oh, damn it, there are like 3 or 4 other questions. So we'll navigate our way.
It's a roadmap. It's not a script.
It's a roadmap, but it's not a script.
That's fair.
It's just a little inside baseball for our listeners. But I want to start, you're relatively new to Bombas. You had a nice career at a few other well-known brands. I think Under Armour, Equinox, a few other places. What was it about the Bombas opportunity that attracted you in the first place?
Oh, man, this place is special. But I think 2 things. I joined 2 years ago. One, it's incredible to be in such a sound mission-based company. Every day, coming to work knowing that we're donating essential clothing items to people experiencing homelessness is it makes it really, really easy to get out of bed, So let's start with the fact that the mission is really attractive. And my version of midlife crisis is sort of not that I need a Ferrari or something. It's that I just don't want to do anything I don't want to do anymore, know? And this is something I really, really, really wanted to do. So felt great about that. The reality is, though, the closer I got to it, it's an awesome business. So when you combine the fact that this is a category, I've spent a lot of time in apparel. This is usually a category that is a bit of an afterthought,
right.
Accessory type basics. To be in a place that's obsessed about it, it does mean that we're running a great business. Nice gross margins, the ability to give back, great teammates, those types of things. So it's really a great combination to be in a place with such a great culture, great mission with just a wonderful business economics.
I think you said on stage that Bombas has something like 44% awareness. Is that correct?
Yeah.
So many of our listeners will know what we're talking about when we say Bombas, but
let's hope.
Let's catch people up if they think about Bombas as the Shark Tank company, or maybe they just haven't been paying attention to the last 12, 13, 14 years that Bombas has been in business. Just give a little sense of the evolution of the business and kind of where it sits today. Yeah,
so it did start in 2013. Started with an Indiegogo campaign, and then that turned into Shark Tank, and so still to this day the most successful brand ever on Shark Tank by revenue, which is crazy. Crazy to think that is crazy. That is crazy. Dave and Randy, they're doing that. Yeah. So approaching $2 billion in total sales since the start, which is still the biggest brand, which is awesome. Damon John was the investor who got involved when they were on the show, and it's been running ever since. So it was really a sock business all along, all DTC during that time. Along the way, call it like...
Not just DTC, but purely online. I mean, I know sometimes we get into the nomenclature of direct-to-consumer. I always think of own stores.
Yeah, no. You're right. Only online. Started to introduce a few wholesale partners around 2020. Had a couple of those. People like Dick's Sporting Goods and Nordstrom were early partners. Had limited assortments in some of those places, and then really once we got to call it like 22 timeframe, started to have slippers. Started to turn that business into something. Launching an underwear business and a T-shirt business because socks are the number 1 requested item in a homeless shelter, but the number 2 is a clean pair of underwear, and number 3 is a clean T-shirt. Yeah. So not surprisingly, the things you put nearest your skin, you'd like them to be your own, you'd like them to be high quality, you'd like them to be clean, and so those are the 3 biggest things, and so that's what we donate. And then obviously the slipper business has taken off as people have just enjoyed our brand for foot comfort. So they keep inviting us into more parts of their closet for that, so we've continued to do it. But along that way, we launched our first stores. So our wholesale business has obviously grown, which we talked a little bit on stage, but our first stores opened in 2025, just in time for holiday. We had the 3 open. We'll open 3 more this year. So that's been the evolution, and now we're a business that's more than 70% socks, about 20% footwear, and then 10% the rest.
Can you just, I don't want to do like a massive history lesson here, but one of the things, we're 306 episodes or so into this thing. And one of the things we've come back to many times has been, the underperformance of many of the brands that started in the era that Bombas did, that had lots of venture capital money and maybe thought they could be online only, and then they thought, well, we need stores because it's cheap acquisition or whatever the heck it was, and many overshot the runway. We talked before we got started about Allbirds and a bunch of others. So it's not about dunking on the people that got it wrong. But what I thought was very interesting among the things you said on stage was just kind of taking through how the discipline of the business in staying focused and not sort of chasing a dream and understanding the relationship between wholesale and direct. Could you just maybe talk a little bit about how you see it, maybe in a way that a lot of the other brands didn't quite do?
Yeah, I mean, and look, in fairness, I mean, I'm reading the history book too, right? I wasn't here for some of those early decisions, having joined the business at 24. But I do think that the landscape evolved, and we talked a little bit about that on stage with Gabrielle, right? Like, there was a time when acquisition costs were $5. People went out and raised a bunch of venture capital money, and they were like, let me just see, how many customers can I go get? And that's fine if you can keep them.
Right.
But if it's a really leaky bucket, then they were just raising again in 18 months, and then they were raising again 18 months after that. And along the way, some of them end up having to raise down rounds because they needed the cash, even though they hadn't been able to show that they had a lot of repeat in those businesses or that they were getting closer to profitability. And then that's where I think some businesses struggled, along the way. For us, luckily, our founders and I think our private equity partners who've been involved for 8 years now, they just instilled a financial discipline that was, I think, maybe a bit more conservative, but better than some other brands saw. So we've been basically profitable since day one, and that has meant we've made good decisions around what acquisition has looked like and not chase growth for growth's sake. On top of that, though, I will say, being where we are in the market, we're a very premium brand in a very accessible category, right?
Right.
$15 for socks is a lot for socks, but it's not so much that most people couldn't decide to do it if they want, right? Just like $8 is a lot for coffee, but it doesn't mean that people don't go get $8 coffees, right? Yeah. And I think being in that space, we deliver the best product in that space. And so while more than 70% of our customers do know that our mission is buy one, get one, or buy one, give one, they also know that the reason they come back, they'll tell us, number one, is they come back for quality. Number two, they come back for comfort. The mission is third. So I talk about those words, quality, comfort, mission, every single day in my job. And I think our ability to deliver on that has allowed us to convert acquisition into repeat. And that's where the economics have changed
and
for us.
Get
Where
sort of the flywheel.
Our funnel is just not so leaky. And there are a lot of businesses where it was so leaky, and then the replacement person was more expensive than the person that fell out. And then that's when the math got really difficult for some brands. We've been fortunate that the repeat side has really, consumers have come along the journey with us, and we've been able to deliver for them in a way. I think you can sell people a first pair of anything because of a story, but a second pair, it better be good. And I think we've been able to deliver on that.
You get to convert that vicious circle into a virtuous circle, literally and figuratively in the case of your business. So let's shift gears a little bit. Let's talk about the culture and your taking over of a business that was started by founders, very successful. So when you arrived in the business, they clearly were looking for someone with a background like yourself. What did you change? What did you see? And what did you kind of walk in saying, I think you're doing amazing things. You got a great running start, so to speak. But what did you look to change or modify or just change a trajectory of something? Talk about that for a bit.
Yeah, I mean, I think first and foremost, what I definitely don't want to change is the culture. The culture and the mission of this place they're good. I mean, I'm laughing. It's such a good place. Like, come to our office, spend 5 minutes there, and you'll be like, man, the vibes here it's just it's a very special place. And when you're there, you're like, okay, don't mess with this. Right. So that's where a lot of the listening was for me, is just making sure I understand the nuance of what we're doing every day and just immersing myself in that culture, being out, volunteering my time with our giving partners, making sure that I'm spending time. I mean, what's great about having 190 employees is I know everybody. Right. And knowing everybody really allows you to understand the culture of a place, to be able to really truly sit with anybody in the company. That's hard to do when you have 10,000 employees, but pretty doable with less than 200. Those are the things I absolutely wanted to keep the same, that I spent a lot of time on. I actually think that the parts I've tried to change are really more about things that we just hadn't done yet. But I think it was an organization that had kind of taken on one new thing at a time. And that was comfortable for everyone. And that's how the strategy worked. And we did the next and then the next. And there was always one new thing. And I think I'm trying to push us to multitask a little bit. We can do a little bit more than one new thing at a time. And I think we're proving that as we expand wholesale, we launch retail, we launch international, as footwear grows. While, all those things can happen at once. Of course, we have to allocate resources to them. We have to be thoughtful about which decisions we'll take and not take. But that's what I'm trying to instill, is the ability for us to multitask and holding ourselves really accountable to delivering on those things, while we keep the mission and the culture at the center of what we do.
We'll be right back with Jason LaRose from Bombas right after these messages. The biggest names in retail don't guess. They use Placer AI. Placer's location intelligence platform turns foot traffic into real strategy, giving you near real-time insights into market share, cross-shopping trends, and trade areas for any location in America. Whether you're entering a new market, tracking a competitor, or optimizing your existing footprint, Placer gives you the data to decide with confidence. Visit placer.ai to see it in action. Physical retail isn't dead, but boring, unremarkable retail is most definitely dead or dying. So how do you become the compelling signal amid all the noise, distraction, transformational new technologies, and escalating competition? If you haven't read Remarkable Retail, How to Win and Keep Customers in the Age of Disruption, Steve's first best-selling book, what better time than now? You'll learn the most important trends shaping modern retail today, explore Steve's 8 Essentials of Remarkable Retail's strategic framework, and be inspired to rise above the rest. Remarkable Retail is available just about everywhere where books are sold, as well as Audible and an ebook on Kindle for $9.99. Let's talk about culture for a bit. So you're not a first interview where an executive's come in with a background such as yourself into a more or less a startup successful. And so we're very interested in how you kind of communicate that. There's going to be a bit of nervousness around, these 190 people. This is change, and we've been successful. Why do we need to change? And the things you're talking about, hey, it was kind of working that we were doing one at a time. Weren't we the most successful brand on Shark Tank? So how did you deal with that? What was your approach to making sure everybody was cool and understood that you were on board? And change was important, but change also wasn't going to be negative, disruptive change, because that's a bit of anxiety sometimes.
Yeah, I think that's totally fair. In reality, a lot of the CEOs I know who have taken over for founders have taken over when the business starts to dip and it gets difficult, and they need to come in and change what's going on because it's not in the right direction. And I think then there's a lot of friction.
Yeah.
For me, I walked in and this place is flying, and I'm just getting on to, I'm flying my leg of it.
Right,
It's like Le Mans, like somebody stopped and now I'm the new driver. But I mean, we were already winning the race,
Yeah.
So
that's interesting.
So I'm just trying not to mess with that. I've been really clear with that with people right up front.
Not going to change the mission, not going to change fundamentals.
No, the mission is absolutely staying.
Work the way it used to work. Maybe a little bit more ambitious around projects.
Yeah,
right?
Look, we're in the office 3 days a week. We used to be in one. There are some things that have changed, and it's like this is the way we're going to do it. But along the way, trying to just continually tell people that the mission is going to be at the center of what we do. We're not, changing give back. If anything else, I've probably overswung on how much we talk about mission and what our donations look like. The time I spend with our giving partners out in the field. That kind of investment, just so that people can look and say, okay, is this guy really in with us? Right. Is he one of us? Is he as bought in, or is he here just with the PE guys? And I think that's that's been a big part of it. And I think I've been lucky that the founders are still around. 2 of them still work in the business all day, every day. David, the old CEO, is my executive chairman. I talk to David every day. I've got longtime employees who are around me or on my team who they'll grab me and say nope, you didn't say that right, or whatever. And just when people want to invest in you that way, I'm super lucky for it because they've helped me navigate any of the times I would have stepped in it, to continually show people that we're a part of it. And I think you can't do it by yourself. I'm lucky to have a lot of people who want to help.
Yeah. So I want to shift a little bit to, this has been great talking about kind of where you've been and kind of the current state, maybe talk a little bit about where you're going. One of the things you said on stage that I loved, and I think I got a good laugh from the audience, was that when you got there, the founders were like, we can't believe we got to $300 million. And you were like, I can't believe you're only $300 million. And which is just, I don't know if you want to just kind of explain a little bit more about that, but you're going from being, I think, over 90% e-commerce. You alluded to you're starting to open your stores. You've opened some wholesale partners. So just Kind of give us the logic about how you think about getting this to be a much bigger brand and what the mix is of your own channels versus working with wholesale partners.
Well, I think building brand is, man, is it difficult, right? And you guys have been in the space, you know a lot of people, right? And even people who've successfully done it, they really struggle to do it again because it's not a recipe. If it were, then you would have written a book about it already and we would have read it and then, everyone would be doing it. It's really difficult. It's this weird bit of solving a consumer need with a great product at the right time, with the right elements. It's elusive for a lot of people. These folks build a great brand. Our founders built a great brand. So for me, that's what gives me belief that the brand ought to go along. There are brands that are much, much bigger than we are who don't make as good a product. Our NPS score is mid-70s, with higher than Amazon's NPS score, right? Our awareness is at 44%. My employee engagement is really high. You look at those fundamentals and you're like, how is this not how do you match those things up with 2% market share? Those things don't really line up. So you just go, great, let's close the gap. And that's really my job, is to go close that gap. And so that's why I believe in the business and just feel like this is a multi-billion-dollar global brand. It's so much bigger than other brands. When you say most of our listeners probably know what Bombas is, it's like, wait, most people know what this thing is and will kick their shoes off to show you they're wearing it. They can't wait to lift their waistband and show me they have our underwear on. That's a regular part of...
That's a lot to take, man.
Yeah. It is a lot, but that's a regular part of my day.
I appreciate it, but...
Yeah, I get that all the time from people. And so when a brand is that loved and that you're delivering for consumers in that way and you're making a high-quality product, you just have to believe that you're just not everywhere that you should be yet.
Sure.
And that's a lot of it. That whether that's categories you're not in yet or distribution or countries that you're not in yet, that's what's got to happen. And that's really my mandate and I think why I'm in the job.
Yeah, and can you talk a little bit more? One of the things I also like that you said on stage, and when I've worked with some brands over the years, I was on the other side at Neiman Marcus, and would hear people pitch us basically, but then when I worked with wholesale brand or brands that wanted to sell into wholesale. A lot of times, and this is basically what you said on stage before our listeners, was that they kind of come in and hey, here's our product, we'd like to sell to you. What you talked about is, as I understood it anyways, being able to articulate your vision, being clear about what you're going to do, what you're not going to do, which assortment makes sense for which wholesale partner, how is it going to look on the floor. Could you just talk a little bit about why that's so important and how that's driving where you're choosing to sell?
I just think you have to know which consumer you're trying to reach and what occasion.
Yeah.
Start there. I think it's a mistake to say we really want to sell our product at X. Why? Because they're big? Because they can place a big order?
Yeah.
That'll happen once. That's great. Then you have to comp it the next year and the year after and the year after, or they're going to close their open to buy. These are smart merchants, right? They're running good businesses. So what's your reason for being? Let them articulate who their customer is, and then let you articulate how you want to meet that customer. Right. And if there's a marriage, then let's be partners. And if there isn't, let's just walk away. It's okay. I think know what people want to stand for, and I think we have that perspective. So, I'll give you an example. We sell at Scheels. If you go into any Scheels store, and by the way, Scheels is a wonderful, example of what it means to be a great retailer, I think, in this country. But if you go into a Scheels and you go to the Bombas area, you'll see who are our giving partners, our 5 biggest giving partners within the zip code of where that store is. Now, we said that's important to us. They said, we like that too. Great, let's do it.
Yeah.
But if they said, we just want to put you on, hooks next to a bunch of other brands and do it, we would say, thank you, but
not for us.
It's not for us, because that's not what we're trying to do. We're trying to reach a consumer who wants to be in their stores, who cares about the details, they care about the technical pieces, they go to Scheels for that kind of expertise when it comes to things like hunting and boot socks and hiking and those kinds of things. And great, we want to glide off of that expertise that they've built, but we're going to bring our perspective, and those things are going to marry together. And that's the way that we do it. But we start with who are we trying to reach with what message, not who could we sell to?
Right.
And it's just a very different approach than I think some brands take. And I'm fortunate that we can do it, but I also think we have the discipline to make it happen.
We've mentioned, you mentioned a couple of retailers. Target's one we wanted to talk about. Very big, and it's kind of a more mass merchant than some of the other brands you mentioned. So does that make the brand advocates or the brand loyalists a bit nervous when they see, hey, that's my brand, now it's available at Target? I get, the worry, has it jumped the shark in some way? Oh, geez, now it's at Target. How do you manage thinking through that?
I mean, actually, we survey our customers a lot. We talk to them a lot as a DTC brand. The number one answer they have for us where do you expect to find us that you don't was Target. The number two answer was, how come you don't have your own stores? So shockingly, now we have Target in our own stores. I mean, but we're listening. We're having this conversation with our consumers. I think the biggest thing is,
so they were making a trade-off between, okay, my favorite niche brand is now more widely available, so it's easier to buy, easier to shop. Is that kind of what the essence was behind that sentiment?
Yeah, so we did it as a test at Holiday, but we did it in a fixture that we built, that they approved, but it was going to look the way we want. It had our mission messaging on it. Yeah. Those types of things. We did only men's and women's. We didn't do kids. We just said, we're going to try it out. We sold out to the piece, and we never put it on sale. They never put it on sale. And I'm even on sale on Black Friday. We will, we'll be 20% off, which is not very deep these days, but we're not a promotional brand. We're full price all year. They stuck to that. They didn't even take us on sale on Black Friday. They didn't take us on sale.
They exempted you from all their
They
programs
exempted us from
all
all the programs, and they sold us at full price every day. Now, they're selling a casual sock for a suburban, usually a mother who's shopping for a family, and that's who their target is. But that's very different than what you find when you go to a Dick's Sporting Goods, and I'm showing you our Run Pro socks, I'm showing you golf and hike and ski, and if I go to Nordstrom, I'm showing you dress. And so there's a very different assortment, so people aren't looking at you and saying like, wow, this is the same stuff I can get at Dick's. It's not. It's very different than what you get at Dick's. It's the same brand, same quality, same comfort,
same mission.
But what you find is this, and if what you want is more technical stuff, then go to the more technical store where the associates know that, and we'll sell you that. And if what you want is something to wear with a suit, then go to the place you shop for suits. But this is what we're doing here. We're not doing that everywhere, and I think we're very deliberate about that segmentation.
Well, and it also seems from a wholesale perspective, I mean, I know this is a little cliche to say that wholesale is great for building awareness, right? But, you're getting someone into the brand in Target, and then maybe later on, right, somebody else in the family is going to move different product, or when they need something dressier, they're going to go online or to your store or to Nordstrom, right? So it's not dilutive in that respect. It should be additive, right?
I think that's what you're paying for, right? I mean, so, the relative economics are different, right? Obviously, your gross margin on a wholesale sale is a lot less because you're selling it at a discount to a wholesaler.
Right.
But what you don't have is you don't have to generate all the marketing and the traffic. And so, yes, of course, I'm paying them to drive awareness of my brand, and I get to dictate, am I going to put the mission story here and what assortment's going to be there? Right. But yes, they're creating that for me, and that's what they've done well to build their strong customer bases. And I give them a discount so that I don't pay that marketing. When I'm the one delivering the message directly, then I pay the marketing. I think that's a perfectly symbiotic way to think about the way we run the business, and I think they do a great job delivering awareness for us on those last mile customers.
Yeah, and I think the takeaway for our audience, and we've had several people on like Joe Kudla from Viore and David Kahn at Birkenstock, and I think the way they talk about it, and you can contrast that from some of the brands that have gotten into trouble because clearly they didn't either understand it or they didn't have the discipline, or they got themselves in a place where they had to sell on Amazon because they were desperate, not because it was a smart distribution strategy. So now you're, as we think about growth, you've moving into footwear, into apparel, competitive categories for sure, right? And tell us a little bit about why that makes sense for the brand. And I think that's a big part of why you're doing your own stores too, because you can show more of your own, more of the expanded assortment.
We can show the full assortment.
Yeah, so just tell us a little bit more about the category expansion.
Yeah, I think, as I mentioned a little bit on stage, so the number one requested item in a homeless shelter is a clean pair of socks, but number two is underwear, and number three is T-shirts. So those businesses are, at the center of our mission. We started as a sock business because we wanted to be able to donate socks, and then added underwear and tees to that because we can do it, using the same ethos around, noticing the details, making sure we're making really high quality, comfortable product. That triumvirate of comfort, quality, mission still stays. I think on the footwear side, it's consumers asking. They want us there. They're saying, well, these are my most comfortable socks. Could you make socks for me? Like, it started with a gripper slipper for us. So it was, okay, can you make cozy socks? We did. Well, can you make some that I can, that are sticky on the bottom for my hardwood floors? And then we did. And then it was like, well, wait, this is like a slipper. Could you make a slipper? Sure. Well, then, and then it just sort of keeps going. And we just keep going into the details and saying, all right, well, but if we're going to do it and we're going to put our brand on it, then what's our quality spin? What's our comfort spin? And how does this tie back to our mission? And those are the things that we just keep talking about. So we'll go where the consumer invites us to go. I think when you made the reference to jumping the shark. I think when you see people who are like, and what we should do? We should make our own soda. And and you see brands.
Or be an AI services company.
or start your own coffee brand or whatever, right? People have done that.
If we're doing underwear, we could do lingerie, right? Lingerie is the next natural step.
And so you see sometimes people don't take that next natural step. They jump 4 steps, and you're like, wow, now you have to explain to the consumer why
you're way ahead of them.
Now you're ahead of them, and now you have to explain it. And if the consumer looks at it and goes, oh, that makes sense, then you're probably doing it right.
Yeah.
And for us, I think we've been able to just follow the consumer along the way. But they keep asking us for more stuff, and we kind of hold back sometimes. And our innovation team's always looking at what the right things are.
Sure.
But I like our position in foot comfort. I love the way that we're thinking about footwear and socks, and the way our apparel businesses complement our mission.
Mm-hmm. Well, you got me more excited about socks on a morning and Wednesday in New York City than I expected to be. I'm now really looking forward to going to the store and doing some shopping. I love me a good pair of socks.
I love that.
If the three of us were sitting down 5 years from today, what would you imagine be different? What's on the roadmap? You've talked about the wholesale expansion. You talked about some international expansion. I wasn't aware of Bombas in Canada. That's not a brand that I don't think you've got any awareness. You've got a little bit of awareness, but is that part of the roadmap? Just take us through what the conversation is going to look like in a few years.
Yeah, so awareness in Canada is actually up to 17%, which is good.
Prompted or unprompted, I have to ask.
No, prompted. I mean, so we started our international shipping, and we now have done that for a little over a year. Far and away, Canada is our biggest country, which is not a surprise for many brands. That's the case.
Yeah.
But we have now 4 giving partners in Canada that handle our donation mission. So every time we sell one into Canada, we're donating another pair in Canada. And I think that's really the expansion of what the mission will look like. I think you'll wake up 5 years from now and we'll say, this is a global apparel and footwear brand that is donating in countries around the world. At that point, we should be donating 100 million essential clothing items a year.
Wow.
Which is an incredible space.
Yeah.
From now we're at 200 million, but those goals, it took, if I'll get this close to right, I think it took the brand 10 years to donate 100 million. It took us 3 more years to get to 200 million. And now it'll take us 2 years to get to 300 million, or
you're compressing that cycle.
You just keep compressing that timeline, and while we're doing it, we have 4,000 giving partners here in the U.S. We're going to take 800 more off the wait list this year, and that's what growing the company is about. When you have a 1-for-1 mission and it's written into your bylaws, you got to grow the company if you want to satisfy more demand, for the for products that are servicing those who are experiencing homelessness.
Right.
So, to add 800 more partners to that, and now think about the partners we can have in Canada and the partners we can have in Europe and in the Middle East, and
no shortage of need.
There really isn't. I think that's the amazing thing is even when we've now donated a couple $100 million, and we'll donate close to 40 million this year, we'll still have people on the wait list, and we will barely be donating outside the U.S. So I think that's really the opportunity. I think if we wake up as a $1 billion company who's donating 100 million essential clothing items in a year, in 5 years, then I'll buy the drinks.
Well, listen, congratulations on your success, the team's success before you arrived, your success since you've arrived, and wishing you much continued success. And thanks so much for joining Steve and I here on the Remarkable Retail Podcast at Commerce Next. It's great to meet you. I'm looking forward to go sock shopping today, so I look forward to checking out the store. And once again, thanks for joining us.
Appreciate it. Thanks for having me, and always nice to talk about socks. Can't wait to hear what you think of the store.
Well, Steve, that was a great interview with Jason. I really didn't know much about Bombas at all, the brand. I mean, Jason came to Bombas with an incredible pedigree of running great businesses. But what were your thoughts on the interview?
Well, every once in a while, and I don't mean this to be, put down any of our other guests, but I think, we get an executive who is just so articulate about the strategy and can put it in the broader context. So I think, I love these interviews to learn more about brands and to talk to great people. But, for our audience, hopefully there's a takeaway there in terms of what makes great branding, what makes great distribution strategy. And I think he's just so articulate about what they're doing, why they're doing it. He's also clearly very passionate about the brand, the mission. And so, I think that's very, very authentic, not to use an overly used word. And, as they grow, I think, very logical about how they've been moving out from socks to undergarments and shoes and slippers and those kinds of things. And, like we've kind of tilted to a bunch of times, but in particular with the discussion around Nike and Levi's, what's the right kind of balanced distribution strategy? Now, they obviously started as an online only mono brand, very focused, but as they add products, as they add distribution partners, as they add their own stores? How does that all work together? And I just thought it was really interesting and a very clear articulation. So it makes our job easy, right? We don't have to ask too difficult questions or go, hey, wait a minute, what about this?
Yeah, it was really a nice, clear articulation, and as you said, very passionate, very, very passionate about the mission, which is pretty incredible. As is his whole team, really gets him up and out and going. Plus, putting great numbers on the board. We've been spending a bit more time this year talking about the grocery aisles, and there's been a development with one of the biggest of the big players, Kroger, who's looking to, fix their growth issues by acquisition. Talk about it.
Kroger announced last week that they're going to buy Giant Eagle. And for our overseas listeners, Giant Eagle is a very strong regional player. So they're down the line in terms of top 10 grocers, but they're very significant in a few states: Ohio, Pennsylvania, West Virginia, Maryland, Indiana. About $9 billion in sales, close to 200 stores, some standalone pharmacies. So, very good size business. Kroger does not have any real overlap in those geographies. So this is additive to them in terms of, not just store count, but geographic coverage. Apparently the plans are that they will keep the Giant Eagle name, they will maintain the headquarters, and really run it as a Kroger division. This is the first major deal for Kroger since the Albertsons merger. So Kroger number one, Albertsons number two as Focus Grocers. And we talked several months ago about their new CEO, Greg Foran, who's a former Walmart executive. This is really his first big move. A couple of things I guess I'll just mention quickly. One is not to make this about investments and too much financial stuff, but the multiple they paid of revenue, we don't know EBITDA, but the multiple they paid of revenue was only 0.2. It's very rare for businesses to get acquired at that low a revenue multiple. So I think that says a lot, presumably, about who might be interested in this business and presumably the profitability as well. So we've come back a couple of times. I think we're going to be coming back to it more. I said, I think last episode or the episode before that, I feel like the grocery business is becoming a lot like we saw with category killers and department stores over time, where being kind of a peak of the bell curve business, a little bit of everything for everybody, is a harder and harder position to maintain. They're getting squeezed on the value side by Walmart, Costco, Amazon, Aldi, et cetera. And then they've got all these high-end players, Whole Foods. They don't have that many plays to run here, I don't think. But I guess my overall take would be, having more stores maybe gives you a little bit of cost leverage because you can get some cost synergies and roll some best practices out. But if the issue is a relevance problem, having more stores doesn't do anything to fix that. So I feel like they kind of had to do this deal because of the contraction going on and the cost leverage. And, it might be once in a lifetime opportunity to pick up a significant player and get that regional coverage and not have to expand your own stores. But I don't see how it does anything for the underlying long-term strategic issue. From a Giant Eagle perspective, which has been family-run for many, many years, the thing that popped into my head was the Steve Miller song. Sorry to our younger customers for this old-time reference, but, come on and take the money and run, because I think they may be getting out at a really good time. Good on them for getting what looks to be a pretty good price and perhaps avoiding the downward spiral that may start to occur in grocery. But anyway, I think this deal will get approved by the FTC because there really isn't much overlap, as I mentioned. And so it's hard to argue there's any antitrust risk. So stay tuned. I think, really the issues with Kroger are going to be more on the strategic side. I think, integrating an acquisition like this is not trivial, but it's not really a big deal in the scheme of things.
It is a very common strategy in the grocery sector. We see it everywhere. We see it here in Canada with Loblaw. They buy a family business like T&T or Farm Boy or Longo's. Sobeys bought them. And they just basically leave them alone and let them run on their own. And then they just get the advantage of going to the vendors with a much bigger pencil or incremental pencil. And they get better real estate deals. Like the foundational elements do make a difference in businesses that are measured by tonnage, right? Yeah. So it's not an insignificant cost advantage when you can bring another $9 billion to
Sure.
Procter and Gamble or whoever. So it's and it works. Sometimes if it's done right, it works. If it's done wrong, it's a disaster. So good luck to the folks at Kroger and
for sure, because of the potential share losses. I think they've been having relative market share losses to the Walmarts, to the Costco's, to the Amazon. Those guys have an amazingly low cost position.
Yep.
So if this helps them get sharper on pricing, that may be more defensive than allowing them to claw back market share, but it's definitely critical to staying in business for sure.
Well, and the vendors like to have more than one option, right? They'd like to be able to take their product to 3 or 4 places, not 2. So there's some upside to all this, to the industry and the structure and all that. So again, best of luck. Now, I would never ever describe anything you write as boring. However, you just did a Substack post that is touches on something that's boring. Talk about it.
Well, I'll just mention this quickly. My latest Substack piece from last week, I titled "Convenience is Boring," which I was deliberately being provocative, but part of the point I'm making, and it's really inspired by an article I would encourage everybody to go find by Tim Wu, that was in the New York Times, called "The Tyranny of Convenience." Now, he was making a little bit broader point about mindless capitalism, which is not so much my point. Not that I'm in favor of mindless capitalism, but it's really more about how once things become, like, if you believe that easy is better and easiest is the best, it almost gets to the point where not having something convenient seems irrational. And I think some of the arguments about the superscalers and AI, where it's all about speed, all about convenience, loses the point that actually friction can be good. So part of what I stand up is to say that friction isn't necessarily the enemy. It is if it's all about convenience. But in a lot of cases, it's clear we're not looking for convenience. So some of the things I get, I have a little subhead, which is nobody ever waited in line for paper towels, but people wait in line all the time for the latest iPhone. You've got your Franklin barbecue hat on for Franklin barbecue, for whatever TikTok croissant or, spicy croissant trend, So I think you really have to be careful to realize that at a certain point, just being convenient is not super interesting. It's key, obviously, to Amazon and Walmart's value proposition. But for those of us that aren't Amazon and Walmart, then what do you do? So, if you show me where the customers willingly put up with convenience, that's probably where you're really creating joy and meaning and differentiation. But it's actually one of my best performing articles so far.
I'd encourage everybody to who's on Substack, or even if you're not on Substack, get on Substack and check out Pardon the Disruption. Steve's Substack page. Do you call it a page or a post, or what do you call it? Channel? I don't know. What do you call it?
Who knows?
Or Substack, I guess. You call it Substack, I guess. Anyway, we'll put the link in the show notes as well, just in case you can't navigate your way over to that. All right. Let's wrap up with what's on our respective radar screens. You go first. You did some store tours in your backyard.
Yeah, well, I'll try to make this relatively quick because this is very much a U.S. story. So for the 40% or so of our audience that is outside the U.S., I'll try to maybe have a few takeaway messages, but I'll go through this quickly. So as a lot of people would know, we talked about it a few months ago, Bed Bath & Beyond is back with a physical manifestation, largely through acquisitions. In particular, what I'm going to talk about is watching what is going on with their combined container store, Bed Bath & Beyond, which I've affectionately referred to as the Ruth's Chris Steakhouse of formats. Bed Bath & Beyond acquired the container store. So far, apparently, they have redone 22 of their 98 stores. So I went out to visit Container Store is based here in the DFW area. I went out to visit 3 stores because apparently I love getting out in the 100-degree temperature.
Very adventurous. Hardy.
But anyway, just like big picture, this is part of their CEO, Marcus Lemonis's Everything Home play. So in about 6 months, the parent company, Bed Bath & Beyond, which used to be Overstock.com, so it's kind of complicated, they bought the Container Store. They bought lumber liquidators. They bought cabinets to go. And this is all organized under this new shopping company. Well, anyway, they've now got this format, which is a blend between a bunch of the old Container Store stuff and some of the Bed Bed Bath & Beyond merchandise. A couple observations. First of all, the co-branding is really awkward. For the most part, they've got the Container Store on the outside, and then they've got signs in the window. So I don't know over time whether they're going to change that. And then you got this kind of funky logo when you walk in. One of the things that I thought was interesting is, and they've been promoting this online as well, they will take any of the famous or infamous 20% off Bed Bath & Beyond coupons. So not only will they take them, even if they're expired, they have huge signs in the stores making that clear. I assume that's not going to last forever. The stores themselves, just to try to give a flavor for it, I would say it's about 80% old Container Store stuff kind of skinnied back, and then selectively some Bed Bath & Beyond merchandise. It's different across the three stores, so I assume they must be testing. Not wildly different, but a couple of the stores have towels, comforters, KitchenAid mixers. It's kind of hard to understand what their point of view is in the Bed Bath & Beyond merchandise, because it is not nearly as dominant an assortment as they were known for. They've lost the wedding registry. They've lost a lot of the health and beauty aids things that really kind of junked up the store. I felt like the assortment strategy is pretty uninteresting. The signing's not great. Maybe something they're also playing with. So I look at it and I'm not really clear who this store is for exactly. Clearly the Container Store was not doing well, and was probably over assorted. So skinning that back makes some sense, but it doesn't really play as an everything home store to me anyway. The other thing is, just from a frequency standpoint, they, as many people would know, they have these closet installations. That's, a really infrequent purchase. Then they have a lot of the organizational stuff and some of these kitchen items, also pretty infrequent. So I don't know. I would say it looks better than I thought it might look, but I'm not really clear what the point of this store is. So time will tell.
Well, for my what's on the radar screen, I'm coming back to something I touched on earlier, and maybe a little more applicability to our international audience between Canada and the U.S. And that's the new Gordie Howe Bridge that's been built between Canada and the U.S. Now, there's an existing bridge called the Ambassador Bridge. It's been around a long time. It's privately owned, and $500 million a day in Canadian dollars trades between our two great nations on this bridge. Now, the trade has been moving to another bridge because this one's not doing so well in a different city, continues to add more cost. I had the opportunity on another podcast of mine to speak with U.S. Ambassador to Canada, Pete Hoekstra, who ironically was a longtime congressman in Michigan, and said, because he brought up we want to improve trade between, trade infrastructure and supply chain between our two nations. I'm like, what's going on with the bridge? Why is this not open? And he basically said, well, we don't like the deal as much as we did. It's not their deal, actually. It's the states between Canada. I won't get into the details of the deal. What I walked away from there, and I'm connecting this, is how and where and how and why do you do a deal with the Trump government when a deal is never a deal, a ceasefire is never a ceasefire? And that's relevant now because the USMCA, the trade deal between Canada, US, and Mexico, has not been renewed. Now, it doesn't expire. That it's like a 10-year annual review process, which just puts it in like review limbo for 10 years. And there's lots of yammering about unilateral deals between Mexico and Canada and this and that. But now we're back at this, when's a deal, not a deal? So it adds another element of uncertainty. It's not a crisis by any means, but it's just like, it just keeps going on and on and on. And as you know, as the listeners will know, uncertainty is fairly toxic to business investment. Maybe that's the point. I don't know. But anyway, we're keeping a closer, of course, here in Canada, and of course, our friends in Mexico are keeping a very much more closer eye, making pilgrimages to Washington to deal with the people who actually deal with these things. But, it does, when we look at the experience of this bridge, it's like, what's the point? Because it doesn't seem like
microcosm of the bigger issue.
Anyway, enough of that. If you want to watch that interview, by the way, very polarizing, super polarizing, actually. It is available online. Half the people watched it and said, thanks for giving, the opportunity for the ambassador to say his piece. And the other half said, what are you guys, shills for the Americans? So anyway, we didn't really.
Like a level of controversy.
Great numbers, though, like a record numbers for us. But anyway, thanks for tuning in. Once again, these are bi-weekly episodes. We'll be back with more great interviews recorded at Commerce Next. So fresh content all summer. Until then, That's a wrap.
Thanks for listening. To learn more about my keynote speaking, best-selling books, and advisory services, go to stephenpdennis.com. And don't forget to check out my Substack, Pardon the Disruption.
Be sure and follow us on your favorite podcast platform or on YouTube and give us a 5-star rating and review. This summer, new episodes will be released every 2 weeks. You can learn more about me or get in touch on LinkedIn or online at emmyleblanc.co.